Financial materiality of ESG integration refers to the extent to which environmental, social, and governance factors influence a company's financial performance, valuation, risk profile, or investment returns. ESG issues are considered financially material when they have the potential to affect revenues, costs, assets, liabilities, cash flows, or the cost of capital. Examples include climate-related regulatory risks, labor management practices, cybersecurity concerns, and governance failures. Investors integrate financially material ESG factors because they provide additional insights into risks and opportunities that may not be fully captured by traditional financial analysis. Financial materiality, therefore, forms the foundation of most ESG investment strategies and investment decision-making processes. The concept of financial materiality is closely connected to ESG analysis and investment practices. Analysts evaluate whether specific ESG factors can influence a company's future financial outcomes and competitive position. Material ESG considerations may be incorporated into company research, forecasting assumptions, valuation models, credit assessments, portfolio construction, and risk management frameworks. For example, a company's exposure to carbon regulation may affect future operating costs, while strong governance practices may improve capital allocation and shareholder value creation. By focusing on financially material ESG issues, investors can better identify long-term risks and opportunities, improve investment decisions, and strengthen portfolio resilience in changing economic and regulatory environments. Double materiality expands the traditional concept of materiality by recognizing two dimensions of significance. The first dimension considers how sustainability issues affect a company's financial performance, which aligns with financial materiality. The second dimension examines how a company's activities affect society, the environment, employees, customers, and other stakeholders. Under double materiality, organizations are expected to assess both the financial consequences of ESG issues and the external impacts they create. This broader perspective reflects growing stakeholder expectations that businesses should be accountable not only for financial outcomes, but also for their contributions to environmental and social sustainability. It therefore extends the scope of ESG analysis and reporting. Double materiality has become increasingly important in sustainability reporting frameworks and regulatory initiatives, particularly in jurisdictions emphasizing corporate accountability and stakeholder interests. From an analytical perspective, investors and stakeholders gain a more comprehensive understanding of a company's sustainability profile by examining both inward and outward impacts. For example, climate change may affect a company through physical and transition risks, while the company itself may contribute to greenhouse gas emissions that affect society and the environment. Reporting based on double materiality improves transparency by highlighting how sustainability issues influence corporate performance and how corporate activities influence broader economic, environmental, and social systems. Dynamic materiality recognizes that the importance of ESG factors is not fixed but evolves over time. Issues that appear financially insignificant today may become highly material in the future because of technological developments, regulatory changes, societal expectations, market shifts, or environmental pressures. Dynamic materiality reflects the understanding that sustainability-related risks and opportunities often emerge gradually before becoming financially significant. For example, climate change, biodiversity loss, data privacy, and human capital management were once considered peripheral concerns but increasingly influence investment decisions and corporate valuations. Investors must therefore continuously reassess ESG factors as materiality changes across industries, regions, and business models. The relationship between dynamic materiality, ESG analysis, practices, and reporting is particularly important for long-term investors. ESG integration requires forward-looking analysis that identifies emerging sustainability issues before they become financially consequential. Companies must adapt reporting practices to disclose evolving risks, opportunities, and impacts, while investors must update analytical frameworks to capture changing materiality profiles. Dynamic materiality encourages organizations to monitor megatrends, stakeholder expectations, and regulatory developments continuously. Together, financial materiality, double materiality, and dynamic materiality provide complementary frameworks for understanding ESG issues. They support more robust analysis, improved transparency, enhanced risk management, and better informed investment decisions while strengthening the connection between sustainability performance and long-term value creation.